Philip, let's start out with what are some of the key factors for the recent market downturn? Try to kind of give us a macro level kind of approach on that.
Absolutely, Richard. Look, I would say that a lot of what we've seen in the market is, I think the easiest way to explain it is it's a little bit of the hangover of the party that we enjoyed in 2021. And so let me just explain what happened. And so following the COVID lockdowns, when we had the reopening of effectively the global economy, in addition to that, you had massive amount of fiscal and monetary stimulus, meaning the Bank of Canada and the federal government provided people with just bucket loads of cash. You had a very, very strong economic rebound. That was the party. They kept spiking the punch bowl. Well, for 2022, to help stem the high inflation that was created by all the stimulus, they start pulling that punch bowl away, and we're left with just a big hangover. And that's kind of, it's a very simplistic way of looking at it, but that's really what happened. You had all the stimulus that led to higher inflation, that has led to higher interest rates. And when you have periods of high inflation and high interest rates, you have a repricing of risk and a repricing of equity markets to effectively the bear market that we've seen in the US and the less than a bear market that we've seen in Canada and other areas around the world. It's part of a normal cycle, to be honest with you. It doesn't feel great when we go through it, but I like to remind people, look at the last 5 years and think of what we've just come through. We've come through a lot in the last 5 years, just the pandemic alone. But before that, we had very contentious elections. We had another bear market in 2018. We had an economic slowdown in 2019. All of that still has led to a 5-year annualized return on the S&P 500 of just shy of 10%. So given all the ups and downs, as bumpy as they've been, we've been left with a pretty attractive, and I would say average return over the last 5 years.
So if I follow that analogy, the hangover, would we say that the vodka in the bowl would be inflation?
The vodka in the bowl would have been all of the, we call it monetary stimulus. The very easy way of thinking about it is during COVID, the Bank of Canada and the Government of Canada printed money. They created upwards of 30% more Canadian dollars that didn't exist in 2019, but they flooded the economy with all that money. So imagine if I just show up at your doorstep and I say, Richard, here's another $10,000. So that creates, I can do that. Absolutely. I'll be there in just a few minutes. But that creates demand, which creates inflation. So when you flood, and we've seen this time and time again throughout history, when you create money like we did during COVID, which was necessary to keep the economy from falling into potentially a depression, the consequence of that is going to be higher inflation. We knew that going into it. The central banks were perhaps in a little bit of denial, saying it's all going to be transitory. Well, it will. We can see signs of lower inflation, but really it's all of that cash created the inflation, which created the repricing of risk.
So if we're focused on inflation here right now, and we're saying, okay, this is what is a root cause of where we're at right now after the government's printing all that money, where do you see inflation going? That is the question I get asked at both private client meetings, at seminars we give. Always the same thing is, where's that crystal ball? I know there's no guarantees, but where do you guys see inflation going?
Yeah, it's actually quite easy to think about. You end up with persistent inflation if the money creation continues at an unchecked pace. That hasn't happened. We saw a spike in the expansion of money, and then it's come right back down to historical normal levels. So historically, when you look at those spikes in the money supply, yes, with a lag of about 14 months, which is almost exactly where we started to see inflation move higher, you get those inflation spikes. But we're already in Canada and the United States seeing downward trend for inflation. We're seeing it from housing prices, gas prices, food prices. Overall inflation is starting to head lower. So is it just going to fall right back to 2% where we were in 2019? It'll take a while to get there. What does a while mean? look, I think we can get there in some point in 2024. More importantly, though, is that inflation is coming down on a year-over-year basis. At the end of this year, we think it'll be closer to somewhere between 6 and 7%. At the end of 2023, it could be around 3%, maybe a little lower, maybe just a touch a little higher. But gradually, that inflation impact is starting to wane. And there are clear signs in the economy now that in 12 months' time, inflation will be much lower than where we are today.
So, okay, so that's great. So that brings me on to, I guess we're going to transition to, well, how are they fighting inflation? I mean, everyone has seen these interest rates that, they're putting capes on and S's on their chest to say, these are what the things that are going to save our lives. Can you kind of expand on that and say, hey, this is why higher interest rates are needed, if you believe that. And where do you think they're going to go? Because that's another thing we get all the time. When is this going to come to an end? When are they going to stop raising interest rates? And I would like, if you don't mind, just kind of even expanding a little bit further and explaining to our clients, it's not just a Canadian thing. This is happening, outside of us. It's not really laser focused on us. Do you mind expanding on that?
Absolutely. Well, to that point, the increase in cash, the printing of money, was a global phenomenon. It happened in Canada. It happened to a greater degree in the United States. It happened in Europe, in England, in Japan. We had about $16 trillion of monetary and fiscal stimulus, government and central bank support during the pandemic. That's massive when you think about it. It's a huge amount of cash being created. And so it's not just our problem. It was a global problem, but as COVID was a global problem, and I'm not blaming governments and central banks for what they did, it was necessary. But if I'm going to play armchair quarterback, my view is that as soon as economies opened up, they should have took rates right back to where they were. The Bank of Canada was very quick to take rates to zero. They should have been just as quick to get rates back to 2%. We wouldn't be as panicked today if rates were at 2% immediately in, say, the middle of 2021. Yet the Bank of Canada has gone further than that. We're at 3.25%. On our way to perhaps 3.5 or 4. We don't know where we're going to end up yet. I'll come to where I think we could end up, but we've seen that. So all central banks were nervous on raising rates too quickly, but they should have done it. Right? And they should have known. Any good economist knows if you increase the money supply, the offshoot is inflation. We've learned that from Zimbabwe, Venezuela, Rome, the Weimar Republic of Germany following World War I. I mean, we've seen this before. We know exactly what the offshoot is, and we know how to cure it. But if you delay it, then and you remain in denial, saying things are transitory, this inflation will just magically go away on its own in a couple of months, you're wrong. But will it go away in, say, a year or two? Yes, absolutely. I fully believe that. And in fact, if all we did was just take rates back to where they were, we perhaps could have just sat back and waited for inflation to normalize as the money supply normalized and consumption normalizes and everything gets back to normal. So where do we go from here, though? Okay, This is kind of the hard medicine, right? What we're seeing right now is with the Bank of Canada increasing interest rates as aggressively as they have, and the Federal Reserve in the United States doing the same thing, we're likely headed towards a recession, right? And I don't think that would surprise anyone right now, given everything that we're hearing out there in the media about it. And nor do I think it's going to be, potentially a bad recession, like a replay of what we saw in the United States in 2008, 2009. Those bad recessions tend to coincide with financial collapses in the economy when banks fail. When banks fail, everyone loses because they help create liquidity or the cash that funds businesses, that funds mortgages, and so on. We don't have that today. So this is likely, in our view right now, to be a milder recession, perhaps short. Perhaps we're in it right now and it'll be over by first quarter 2023. We don't know yet. But given how strong the labor market is and how relatively strong the consumer is, it doesn't seem that this is going to be a bad one. But what we know from history is that the central banks raise rates into the next recession. And that seems that that's what they're doing now. How far will interest rates go? In Canada, We're at 3.25 today. I think we can get to 3.5, maybe 3.75, and then the Bank of Canada will have to stop because they will see the evidence of the economic slowdown, which we're already starting to see in pockets of the economy. In the U.S., I think the Federal Reserve could get to 4% before they have to stop. But ultimately, I think 4, maybe 4.5 if they really try and push it. But I think 4% is going to be the top end in the U.S., and I think 3.5 to 3.75 is going to be the top end in Canada.
Okay, so I mean that's great stuff. That's amazing stuff, and we fully believe here, at Richard Salson Associates, like knowledge is power. So we don't shy away from any topic. I'm really glad you brought up that recession. Would you equivalate, because a lot of what we've been getting back is this has shades of 89, 90, 91. And I remember that because that's when I pretty much started in the workforce. And I started in a recession. I was fortunate. I worked for a bankruptcy company. I didn't really feel it, So would you say it kind of has those flavors and spices and tastes, or would you think this is something unique that we're going to go through?
It's interesting that you bring up 1989. I've spent a lot of time studying it, and my experience in 89, like 88 and 89, my part-time and summer job was working construction. I worked on site. I was one of the guys that went around and cleaned the houses after all the trades. And then the summer of was it 90 or 91, there were no jobs because there was no construction. So I've gone back and I've looked at that. Housing, interestingly, from 1989 through 1992 in Toronto had fallen by 50%, housing prices. Now, I don't know if we'll see that. We're seeing housing prices fall now, and it stands to reason. As interest rates move higher, mortgage rates being renewed, or mortgages being renewed today, are renewing at a higher rate than the expiring mortgage. And that is likely to be the case as long as interest rates stay at these levels, which could be next year, a couple of years. But that starts to pinch the consumer because that money is going to basically fund the mortgage that would have gone somewhere else, not savings, consumption somewhere else. Is this like that? Well, it was a pretty bad recession in Ontario in 1990, and probably most of Canada around 1990. I don't think it's going to be like that. Again, I think the labor market is still very, very strong. And I think that with plentiful jobs, you can see the consumer hold up. I think we will see some weakness in consumption and some weakness in the housing market. But at this point in time, I don't think it's going to be quite as bad. And again, also leading into the 1990 recession in the United States, there were these financial collapses, the S&L crisis, long-term capital management, which was a hedge fund that blew up. But we don't have those today for now, and hopefully we won't see those. So I think this is going to be much more like, say, 2001, where it was a recession that was declared after the fact, when in the United States, the National Bureau of Economic Research said, oh, by the way, last March through November, we had a recession in the U.S., and everyone was like, really? I barely felt it. I think this one could be like that. Again, milder. We call it a little r recession as opposed to big R. Logic would say that, yes, we are headed there. Right now, it does seem that it's just a softening of the economy as opposed to a hard landing.
So that's great. So I guess our question now is, and leading into the whole mortgage situation, which you brought up, because I remember, in the 90s, you really had to wait till about 97, more or less, to kind of get that value back in your home. So what I'm hearing now is it's not going to be that 6-year kind of gap, might be a little bit smaller. Do you believe as interest rates are held, the pricing on housing, which is a really big topic with a lot of my clients, and especially the seminar clients, do you still believe there'll be longer term pressures on it even after the fact? And by this, what I'm saying is, do we believe they're going to start retracting or lowering interest rates quickly in 2024? Or do you think it'll be a very slow pace so that people who did buy homes in 2020 will actually be renewing at much higher levels, right?
Yeah.
So now we're kind of really getting that crystal ball out there, right? I'm throwing the long bomb there, right?
Well, you know what? Really hard to say, but I'll take a stab at it. Typically, I don't like to forecast more than 12 to 18 months out, but you know what? I know this is at the heart of every Canadian. Housing is a very passionate topic for us. Yeah. So I'll say this. Again, that parallel to 89 through 92 when housing prices fell by 50%, it did take almost 10 years to get back to the prior highs. And so would this one be just a short minor blip like we saw in 2008 or 2009 in Canada? Or is this going to be something longer like we saw in the US? I'm led to believe that it's going to be something longer. And I'll explain why. First, I don't think the Bank of Canada is going to be as quick to take rates back down. First of all, I don't think we're going to go to zero. If we did see a softening of the economy, I think the Bank of Canada will cut by 50 basis points. It'll be the insurance cut, right? But they'll want to hold that line to make sure inflation doesn't pick up again. And I think that's everyone's fear, is that what if we get inflation like the late 70s, early 80s, which I don't think is going to happen. Again, there's evidence to support, a lot of evidence to support that inflation is going to be lower. And demographically, it's unlikely to happen because inflation is in part a function of population growth rates. And the Canadian growth rate, population growth rate has been relatively low for a number of years. The last spike that we had was in the mid-90s, and so that's rolling off now. So back to housing though, and this is where human psychology, I think, comes into play. When we get shocked like we are being shocked right now, it tends to leave scars. And those scars can shift us from being a seller's market to a buyer's market. And you end up in what's called a paradox of thrift. Whereas if the new buyer today says, well, you know what, if we just hold on, this house has been listed for 4 months, or 4 weeks rather. If we hold on a little bit, they are likely to drop the price, or we can come in, we used to call it a stink bid, right? We can come in with a low bid and see if they take it. And so you get that mentality taking hold where the buyers now say, I don't need to put in a bully offer, in terms of like, I'm gonna try and bid the highest right now and get everyone else out of the way. I can wait. I'm going to wait until the seller becomes a little bit more desperate and nervous and now accepts my price. So that can take time to work its way through. We've seen years where housing prices in this country were at levels that really are difficult to justify based on our incomes.
Yes.
Now, I think we can get a rotation out. I mean, some of the Canadian real estate markets are the most expensive in the world. And that was all on this frenzy of bidding. I need to get into a house. Well, I think we could be in a period where housing prices can take a few years to recover. First of all, I think we have more downside. I think there's more downside to come. I know not everyone likes to hear that, but I think we've just seen the start of prices dropping.
Yeah.
And then I think it could take years to recover back to the prior levels because interest rates won't go back down to zero. They won't be back to the levels that we saw in 2020, potentially for a long time.
I really love the honesty. I've been saying quite adamantly to clients and to people who come see me speak that there's a general malaise that hangs in the air when recessions start and the thrifting. I love that. I'm going to steal that, by the way. I'm going to take that. And it is the thrifter mentality. It is that sense of, well, I have cash now, so I am king. And generally, that is the truth. I mean, if you're going to borrow $100,000 now, you're going to spend 6%. That's a considerable, tax. And so I do agree with you wholeheartedly on the general malaise. But now, I mean, we've discussed the interest rates. We've discussed, what caused this. We've discussed inflation, and now we've discussed the actual where we are, which is going into a recession. I couldn't agree with you more on everything you said. And now I'm going to kind of put you on the spot to say, all right, if you were going to work in the next 12 months in these markets or in these environments, where would your recommendations be to say, okay, here's what we're looking at as an institution, as a director, here's what I'm looking at, and this is what you should be looking at. Mm-hmm. Fair enough?
Absolutely. Okay. The first thing, Richard, I would say is we have to remember that markets are forward-looking mechanisms. Right? The market is never reacting to necessarily the news today, although it can feel like it. In general, we're reacting to expectations over the course of the next 6 months. So what we're seeing in the market right now is really a view on where the economy is going to be in 6 months' time. And Equity markets tend to bottom well before the recession ends. Potentially, we are in a recession now. We don't know. I would say we're not in the heart of it, but we're close. So I'm actually not fearful of the markets going forward over the next 12 months because we've priced in a lot of the economic weakness that's expected. And we were just chatting before the call started. We've had some pretty healthy volatility. A couple things I take away from it. First, volatility in September is the norm, not the exception. The majority of the time, September is a bad month for the equity markets. Seasonality kicks in. It's also an election year, and we get some uncertainty in the United States election year. You get some uncertainty around that tends to weigh on investor sentiment. The second thing is, we've been talking about recession all year. There's been speculation that we're headed towards a recession. Now there's evidence that we likely are. So knowing that, what else can surprise us? So this is where the markets have priced it in. We have had a bear market in the United States, being down 24% from the January 3rd high. I'm actually becoming more optimistic as I look forward over the course of the next 12 to 24 months, even though, again, we're sitting here saying, yeah, we're probably heading towards a recession. Are you worried about it? Not really. Why? It seems to be priced into the market. So when I look at, for example, the TSX, the Canadian stock market, it's trading at a level, when we look at valuations, we measure valuations, what's the price you're paying for the earnings income you're getting out of these companies. They're the cheapest levels that we've seen in 30 years, just about. And they've only been cheaper 4 times. 95, you've got 1997 in there. We're looking at 2008, 2009, and then 2020. In each of those periods, the 1-year forward return was double digits.
Right.
And so we're in one of those very rare periods when the markets are this cheap. And you look at that saying, well, it looks like the market is pricing in the worst. So anything better than the worst is good news.
It's good news.
And we should see things move up. The other interesting parallel is in the United States. Again, U.S. has come through a 24% bear market. Top to bottom valuation is down about 43%. So when we look at, again, what's the price versus the earnings that you're paying, that is down over 40%. And that's something that I pay attention to. It's very similar to what we saw between 2000 and 2002. And in fact, the levels of value are almost identical. And so we're at the bottom of the market in 2002 right now. And going forward, again, the market responded with an attractive rally. And then you had a couple of years of just, average to slightly below average returns. But yeah, I would say positive returns going forward are more likely the norm given the storm that we've just come through. So when I look at, and I should say, not only for equities, but when we look at fixed income, we look at bonds, and it's been a very, very challenging year for bonds. Reason being is interest rates go from 0 to 3.5% or 4%. The price of the bond falls sharply. But we're at between, say, 4 and 9% for some bonds out there, offering yields that we haven't seen in over 15 years. It's a good environment for fixed income. It's becoming a more attractive environment for equities. So when I look at the portfolios that I manage, I'm looking much more balanced. I am on the equity side looking more towards international equities, Canadian equities, emerging market equities, where they seem to be priced for the absolute worst. And on the bond side, I'm starting to pick up very, very attractive yields that we haven't seen for quite a while. And bonds, given where yields are, look to return to that defensive posture in our portfolios. So if we're wrong on the equity side, bonds should do very, very well. But if we're right on the equity side, we'll still get a positive return out of bonds going forward. So it's actually a good time to be an investor. It's been a very challenging time over the last 12 months. We've come through a period where returns were truncated to the negative, but now we're coming out of that. Yes, the economy doesn't look great, but we've already priced that in. We know that. What's there left that can surprise us?
That's amazing because it's something where there's a disconnect in people's minds. I mean, my real estate value is declining and is forecasted to decline for a while. Yet here I am being told, hey, our markets are going up. We're going to be in a really good position. in a little while. And I really thank you to kind of, help explain to clients the separation of how one doesn't require the other exactly, or doesn't follow the other. And I think that really helps drive home the point of saying, hey, you know what, from a market perspective, we're priced in well before real estate took the dip. And then we're kind of, coming out of that, the let's call it the eagle rising from the ashes, right? And then what we do have is a real estate market that will be affected for a little bit longer, and you have to be more aware. I want to thank you today. If you want to wrap up on anything, this has been fantastic. I'm sure everyone here is going to take a lot of that information that you have and empower themselves, right? I firmly believe sticking your head in the sand is not the way to go into your financial future. It's better to know, speak the words, have the power. Is there anything else you wanted to add, to kind of close out?
Absolutely. Yeah. And I've had numerous conversations with clients over the last number of months now that are quite nervous about what's been going on in the marketplace. And many of them recently have been asking to go to cash and just the other day I was speaking to one who said, well, why don't we go into cash, or why don't I go into cash and then I can wait till the bottom and then, we can reassess then. Sounds easy, but very difficult in practice. Investors, when the markets are down, are reluctant to buy back in. They only tend to come back in when the markets have fully recovered. This is just the way investor psychology works. And so I would say what we need to do as investors is really think about our goals. Our goals oriented over the next 10 years, 20 years, 30 years, and including retirees. We forget, Richard, that someone entering retirement today has a 30-year time horizon. And going to cash and missing the recovery is to lock in a loss of potentially 10 to 15%, and you can't get that back. You're always going to be behind. Versus, and I don't necessarily say just buy and hold and forget it. We're always shifting the portfolios around to the better relative opportunity, but that doesn't mean when the markets are down, we won't be down. We're just going to try and be down less and then put ourselves in a position to recover faster. Now, thinking about that, all of the questions that I've been getting recently about should we be going to cash, I'm really nervous. It's actually encouraging for me because typically when that happens, it's a good time to buy. It's when clients are calling and saying, I want to buy, a tech company, I want to buy energy, I want to buy whatever. That usually means that we're near the top. So just given the poor sentiment out there, I think it's a good sign. But more importantly, valuation matters. And if you think about where we are from the stock market perspective today, and if you can have that vision 5 or 10 years out, we're in a very good position, I believe, to generate some significant gains. Is that going to be in the next 12 months? I don't know. But is it likely to be over the next 10 years? Absolutely.
Yeah. And I take an adage from Warren Buffett. When people are selling, I'm buying. When people are buying, I'm selling. And so this has been fantastic. I thank you so much. Your wealth of knowledge. I heard you speak at Apex. It was fantastic. I wanted to share this with clients and future prospective clients because I think they need to hear this. And honestly, I think that they're missing out on a lot of great information. So once again, Philip Petursson, thank you so much. We appreciate it. And thank you for your time.
Thank you.